The next major asset class isn't in your stock portfolio, your bond allocation, or your real estate holdings. It's in the ground. In the metals and minerals that make electric vehicles run, AI systems think, defense systems function, and every smartphone on the planet operate. Institutional capital is moving into these resources, not through traditional commodity markets, but through blockchain-based ownership structures. Every technology driving global growth today depends on materials most investors have never considered. Rare earth elements, a group of 17 metallic elements, are not interchangeable with ordinary industrial commodities. They are enabling materials. Without them, you cannot manufacture an EV battery, a fighter jet guidance system, a wind turbine magnet, or a high-performance semiconductor. Ownership of rare earth elements is expensive, operationally complex, and impractical at scale. Storage, authentication, transportation, and custody all introduce friction that eliminates the trade for most institutional investors. That friction created a gap in the market, and blockchain technology is now closing it. Institutions are no longer trying to stockpile minerals. They are acquiring verified liquid claims on strategic supply. Blockchain tokenization works on a straightforward principle. A quantity of physical material, authenticated, insured, and held in secure custody, is represented by a corresponding number of digital tokens on a blockchain. Each token is a verifiable legal claim on a specific quantity of that material. The underlying reserves are independently auditable. The result is that what was previously an illiquid, operationally complex asset can now be owned, traded, and managed with the efficiency of a standard financial instrument. Ownership transfers without physical movement. Transactions settle with full transparency. Supply provenance is traceable through an immutable record. Sophisticated capital allocators do not wait for consensus. They position ahead of structural inflection points. The institutional thesis for rare earth exposure rests on a convergence of long-duration demand drivers, reinforcing one another simultaneously. Electrification is the most visible. The global transition to electric vehicles requires rare earth magnets at a scale that current production cannot reliably sustain. Every major automotive manufacturer is locked into sourcing agreements or scrambling to establish them. AI infrastructure is less discussed but equally significant. The hardware required to run large-scale AI systems depends on rare earth inputs that are not substitutable in the near term. Defense spending is accelerating across NATO member states and allied nations. Modern precision weapons, communication systems, and surveillance technology are all rare earth intensive. Investors who understand that strategic mineral access will become an increasingly priced-in geopolitical asset are building exposure now, before that reality is reflected in mainstream valuations. Access to this asset class is no longer restricted to sovereign wealth funds. There are three concrete ways in right now. The first is rare earth mining equities. Publicly listed mining companies offer direct exposure to mineral demand growth, accessible through any standard brokerage account. Evaluate jurisdiction, reserve quality, and balance sheet structure. The second is critical materials ETFs. Several funds track the broader strategic minerals sector, offering diversified exposure with lower single company concentration risk. Check expense ratios and examine what the fund actually holds. The third, and most structurally novel, is tokenized commodity platforms. A growing number of regulated platforms now offer blockchain-backed exposure to strategic minerals, including rare earths. Due diligence is non-negotiable. Custody arrangements, legal structure of token ownership, regulatory status, and the quality of reserve auditing all require careful review. Each path carries a different risk-return profile. Know which one matches your objectives before you allocate. Before you allocate to any of this, here is what can go wrong, and it is specific. Tokenized commodity markets are early stage. Regulatory frameworks across major jurisdictions are still being defined, and how these assets are classified will determine how they can be held, traded, and reported. Platform risk is real and varies considerably. Custody arrangements, smart contract security, and reserve verification are not standardized across providers. Some platforms claiming asset-backed tokenization do not have the operational infrastructure to support that claim under stress. Market liquidity in tokenized rare earth assets remains limited. Price discovery mechanisms are still maturing. This is not a category for capital you cannot afford to hold patiently. Research is not optional. It is the baseline requirement for participation. Regulatory clarity will be the catalyst that unlocks mainstream institutional participation in this market. It is coming. The timeline is the variable. The allocation of institutional capital into strategic mineral reserves, structured through blockchain ownership, is not a speculative narrative. It is a rational response to durable supply-demand dynamics and the emergence of digital infrastructure that makes these assets more accessible than they have ever been. The investors who benefit most from structural shifts are those who understand the mechanics before the mainstream does. The fundamentals are in place. The infrastructure is being built. The question is whether you will be positioned when it moves. If you want analysis on strategic resources, emerging financial infrastructure, and real-world blockchain investing, subscribe and follow the channel.